I looked at this book. I did what everybody else did. I just burst out laughing. Super boom, why the Dow will hit 38,820 and how you can profit from it. Jeffrey Hirsch with B. Ritholtz writing the intro. This is a great book. It's miraculously, wonderfully thin. Everybody wants to write like 400 pages that nobody has time for. This is like a tweet, but it's terrific of how you get there. And the lead here is it's out 15 years.
Yes.
You're thinking long term.
Totally long term. Very long term. We got some issues to work out over the next 5, 6, 7 years, depending upon what goes on, with inflation, with the economy, with the war, the wars, the new one we've started. So there's a lot to work out over the next several years.
The sub-theme of the book is, look, folks, there's going to be inflation. Right. We got to get out in front of it. Yours is an 8.1% return over 15 years to get to 38,000. That makes, that's a rational kind of things. But it's not a double-digit world. Are we in a single-digit world now in terms of equity return?
I think over the long haul, yes. I think we're going to get some big years. I think the double-digit returns start kicking in 2017, 2018, like we had in the late 90s or when the boom took off in 82. There were some big years there also. So I think we're going to be backing and filling over the next several.
Here's the most important quote in the book, because when Jeffrey Hirsch talks, there's a lot of legacy here. This is from Sir Isaac Newton, who had a stock portfolio with stock. He had a Stock Trader's Almanac by him at his desk in the 17th century. If I have seen further, it is by standing upon the shoulders of giants. You wonderfully in your redux what was a religion in our house, which was Stock Trader's Almanac. In the back here, Smart Money, 1977. It's like a Lou Rukeyser moment almost. Is your theories the same as Yale Hirsch's?
Oh, it's built right on top of that. Those are the shoulders I'm referring to. Luckily, the man's over 6 feet tall, so I can see pretty well.
Sure.
But it's the cycle that he discovered back in '76. It's this boom period after wars are over. The one we had after World War I was the Roaring '20s. One we had after World War II, the TV 50s and 60s boom, and then the information revolution after Vietnam. So it's totally built on that same cycle, that same premise, that same pattern that Yale discovered.
A lot of big cap things. Let's bring this up. This is from Jason Trennert. It's a ratio of NASDAQ 100 to S&P 500. Do you want to do this with a small cap push over 15 years, buy and hold, or do you really got to go large cap?
You buy what you like. Small caps are one of my favorites. I would be buying small caps. I like buying the market when the Dow's below 10,000, and when we've heard bear market officially declared in the media, that's the time to get in. You like dividend stocks, pick those up. There's some sectors that I talk about also that I think can fuel that next boom, where that next enabling technology may come from. It could be energy tech. I think if we can harness the sun like Edison told us we should do back in the turn of the century, that would be one of the keys.
Everybody loved Intel in 1997. Bring up the chart. Oops, too much information. It is. It was ugly. Here's Intel. Up it goes, big boom, and then it's really gone nowhere. How do you avoid the stocks that just end up sort of being cyclical and going nowhere? How do you get on those Colgate-Palmolives of the world?
I think if you look at those kinds of stocks, you're looking for companies to continually increase their dividends over 10 years and beyond. You're looking for the companies that have proven that they can make money and pay out money in all kinds of markets and all kinds of economies. I think if you're looking for that kind of stock to play, and there's a bunch of them we recommend in the book, that's what you look for. Sort of chronic dividend payers and increasers.
Stock Trader's Almanac, Commodity Trader's Almanac, great super boom, 38,820. I'm thrilled, but what do I do when I'm scared? I mean, you got Douglas Cass endorsement and, Ken Fisher's on here. Great. But the bottom line is there are those moments where there's a real argument in a kitchen or, frankly, in a bedroom about money. How do you not sell in the spring of 2009?
You have to go against your emotions. I mean, everyone was most afraid on the weekend after March 6th. We had that bottom next day. That's the time to buy. That's that contrarian investing method. That's what you do over the next several years. You wait for dips. You buy bear markets. You buy when the Dow crosses that line in the sand, and you're just looking to sort of go against the grain, go against your normal emotions.
Bring up the Dow chart here from the Depression. We're introducing folks a bunch of heritage charts here. Look at this chart. This is going to make Jeff Hirsch he's going to start shaking. The Dow off the Bloomberg. This is logarithmic, so slope matters, percent change matters. That's a depression in the lower left corner. That's a depression. And don't show me, Rex. Come on. Show the chart. There it is. There it is in the lower left corner. That big
right.
percentage
That's the launching
move,
pad.
and then up we go. And
we don't break out until after World War II's over.
Yeah, but there's a big boom in the Dow.
That's
you
right.
say believe in stocks. Right now, stocks aren't all that loved, are they?
They're loved a lot more than we were a couple years ago.
That's for sure.
We're up quite a bit.
When do we go through 14,000?
I don't think we're really going to leave it behind until 2017. I think we may touch it and dance around it a couple times. We'll come back through 10. I don't think we're going to make a new low, but we're going to threaten it before this flat period's all over.
Okay, let's bring up what I'm watching here. Jeffrey Hirsch, thank you so much.